Laporan tahunan akan memberikan penilaian mengenai perkembangan serta prospek ekonomi global dan Malaysia. Laporan kestabilan keuangan dan sistem pembayaran pula akan menerangkan penilaian terhadap kestabilan sistem keuangan serta polisi dan pembaharuan struktur keuangan yang dilaksanakan sepanjang tahun 2018. Tahun 2018 merupakan tahun yang penuh cabaran bagi ekonomi negara, sama ada daripada faktor luaran maupun dalam negara. Walau bagaimanapun, ekonomi Malaysia telah mencatat pertumbuhan yang baik sebanyak 4.7%. Sektor kewangan kekal stabil, walaupun keadaan pasaran kewangan agak tidak menentu. Pada tahun 2019, keadaan ekonomi dijangka kekal mencabar. Pertumbuhan global yang perlahan di samping pelbagai risiko yang boleh menjejaskan prospek ekonomi global dan pasaran keuangan dunia merupakan cabaran utama yang bakal mempengaruhi pertumbuhan ekonomi Malaysia pada tahun ini. Walau bagaimanapun, momentum pertumbuhan ekonomi negara dijangka kekal mampan dan akan berkembang pada kadar 4.3 sehingga 4.8% pada tahun ini. Izinkan saya menjelaskan dengan lebih lanjut prospek dan cabaran yang bakal dihadapi. If we recall, following the solid performance in 2017, the global economy started on a bright note in 2018, but it took a turn towards the second half. Trade disputes intensified. This was coupled with volatile commodity prices during the year. Monetary policy normalization in the US triggered a portfolio reallocation away from emerging markets. This led to large capital reversals, strong currency depreciation pressures, and substantially tighter financial conditions among some emerging economies. As a result, we saw slower global trade activity and a more moderate growth momentum across most advanced and emerging economies in the second half of the year. In Malaysia, we faced several major domestic challenges as well, ranging from unplanned commodity supply disruption to a historic political transition. Despite all these headwinds, Malaysia recorded a respectable growth of 4.7% in 2018. Looking ahead, the global economy is likely to grow more slowly. Tracking latest indicators, the weaknesses seen in the second half of 2018 are likely to persist at least for the first half of 2019. Risk and uncertainty are also rising. Many of these are policy and political risks, for example, trade conflicts and Brexit, whose outcomes and repercussions will have a material impact on global growth and international financial markets if not managed judiciously. How will our economy and financial market fare, especially in light of these global headwinds? With highly open trade and financial markets, Malaysia will not be immune to these external developments. However, country-specific factors and appropriate policies will help sustain our growth. Our baseline assessment is for the Malaysian economy to remain on a steady growth path of between 4.3% and 4.8% in 2019. The three key factors that will support this performance are: 1. Resilient private sector spending; 2. The recovery from unanticipated supply disruptions and capacity expansion; and 3. Continued export demand from key trading partners, although at a more moderate level. Let me explain this in greater detail. The private sector, forming 3/4 of the Malaysian economy, has been a key engine of growth. To put this in historical context, private sector spending has recorded positive sustained growth over the past few decades. Excluding periods of severe economic shocks, private sector spending, namely household spending and investment, has always grown above 5.6%. Household spending recorded a strong performance in 2018, with strong income and employment conditions, as well as boosts from temporary factors such as the tax holiday and strong sentiments. As these temporary factors wane, we expect spending to normalize in 2019, but still remain firm. We expect stable wage and employment growth to continue supporting household spending. Industry findings affirm this outlook. A salary survey by the Malaysian Employers Federation suggests sustained intentions on salary increment and bonuses. In our engagement with the various industries, 92% of firms indicated they will sustain or increase workers in 2019. Cost of living pressures will continue to be an issue that weighs on household spending, particularly for the lower income households. This is one of the factors that dampens household sentiments. A partial relief comes in the form of targeted measures by the government to alleviate some of the burden faced by the affected households. Growth will also be supported by continued investment activity by businesses. Amid a host of external and domestic factors that give rise to uncertainties, business sentiments have recently softened. Nevertheless, firms' intentions to invest remain. This is reflected in the significantly higher investment approvals of 87 billion ringgit in the manufacturing sector last year, compared to 64 billion in 2017. In the E&E and primary related manufacturing subsectors, firms will continue investing in automation and efficiency enhancements. In the services sector, firms will continue to expand capacity to cater to demand, including in the transport, storage, and communication subsectors. We continue to see healthy levels and growth of financing disbursed to facilitate private sector activity. Notably, loans disbursed in 2018 recorded the highest growth since 2014 at 7.3%. The higher disbursements was broad-based across segments, including SMEs. More funds were channeled across most sectors. In line with higher disbursements, total loans in 2018 exhibited higher growth. Looking into 2019, there will be continued availability of credit as banks are targeting higher loan growth. This underscores the bank's continued willingness to extend financing to eligible households and businesses who have the capacity to repay their loans. However, loan growth is also a function of demand for financing. Towards end 2018, we have seen loan applications declining below its long-term trend, while loan approvals remain stable. Barring a pickup in applications, this may point to slower momentum in loan growth. SMEs play a critical role in driving growth and continue to have access to financing. In 2018, 3 out of 4 loan applications were approved. This translates to more than 123,000 approved applications, resulting in 307 billion ringgit disbursed to SMEs. In particular, more than 7,800 SMEs received CGC guarantees, while 13,000 applications by micro enterprises were approved under the scheme Pembiayaan Mikro. We conducted an SME finance survey in 2018, where SMEs cited greater challenges from rising competition, fluctuating demand, rising costs, and labor issues. Notably, difficulties accessing financing was ranked 8 out of 9 key challenges faced by the SMEs. The result of the survey is highlighted in one of the box articles in the Financial Stability and Payment System report. There are ongoing efforts to enhance the SME financing ecosystem. For instance, guarantee schemes by this Credit Guarantee Corporation and Syarikat Jaminan Pembiayaan Perniagaan, Bank Negara funds for SMEs, and scheme Pembiayaan Mikro provide support to viable SMEs with inadequate collateral or track record. Last year, seen disruptions in the mining and agriculture sectors. These disruptions are expected to dissipate this year, contributing 0.3 percentage point to growth in 2019. The recovery will be supported by the normalization of natural gas production in East Malaysia and higher palm oil output as the impact from poor weather eases. Besides commodities, recent investments in manufacturing capacity expansions are expected to start production in 2019. We see this happening across major industries, including fast-growing E&E segments such as automotive and medical devices. Importantly, the operationalization of RAPID in the primary-related cluster will start to raise refined petroleum capacity. Over the longer term, downstreaming efforts will deepen our economic complexity and promote greater diversification to mitigate commodity-related shocks. Being an open economy, Malaysia will be affected by moderating global growth. Exports are likely to register slower growth this year. Much has been reported on the global tech down cycle. While that is true, there are also faster growing segments, for example, automotive, semiconductor, medical devices, and chemicals, areas that Malaysia is involved in. Thus, our diversified manufactured export base will help to sustain export performance in 2019. The outcome of resolutions of trade disputes among major economies remains crucial, as it could swing the momentum of trade activity. Trade actions implemented since early 2018 are estimated to lower Malaysia's gross export growth by 0.6 to 1 percentage point in 2019. This is in our baseline projection. Malaysia has the potential to benefit from trade diversion by 0.1 to 0.4 percentage point. At this juncture, we consider this an upside risk and have not included this in our baseline projection. This is more likely to occur for products with significant presence of the US import market and if the manufacturers have the capacity to ramp up production. With the inflation rate being negative in recent months, there were concerns that we are facing the threat of a deflation. Let me be very clear that this is not the case. Deflation occurs when price declines are broad-based. We do not observe a widespread price decline that typically results from a collapse in aggregate demand. The chart on the right shows the percentage number of CPI items experiencing month-on-month price changes. A stable share of items have experienced price increases in recent months. In other words, the price decline is not pervasive. In fact, the recent negative inflation was mostly accounted for by lower domestic fuel prices. This is different from a severe drop in spending, such that firms generally have to cut prices to attract consumers. Removing the impact of price volatile and price administered items would give us a better sense of the underlying price pressures. The impact of consumption tax policy changes should also be excluded due to its transitory nature. Core inflation, a measure that excludes these factors, has been stable, consistent with a steadily expanding economy. Overall, we expect headline inflation to be broadly stable, averaging between 0.7% and 1.7% in 2019. There will be some pass-through from domestic cost factors, but this would be offset by lower global oil prices and price ceilings on domestic fuel prices. Underlying or core inflation is expected to be sustained given steady expansion in economic activity and the absence of strong demand pressures. This year, we feature an article that assesses whether workers are compensated with the appropriate level of wages given their productivity and relative contributions. Overall, our research suggests that income earned by workers in Malaysia are below their productive worth. To illustrate, at the same level of productivity, workers in Malaysia are only paid 2/3 of the wages in benchmark countries. Workers in Malaysia are also not paid equitably. In Malaysia, workers play a larger role in the production process, given the prevalence of labour-intensive industries like wholesale and retail, food and beverages, and accommodation in our economy. However, the share of national income accrued to workers in Malaysia is lower than in benchmark economies. High skill, high wage job creation is crucial in Malaysia's transition towards a high-income economy. Instead, there has been faster growth in low-skilled jobs in recent years due to the expansion in labor-intensive industries that pay relatively low wages. Hence, comprehensive reforms are critical. Attracting quality investment would generate more high-skilled jobs for our workers. Beyond that, we need to reduce labor mismatches, improve labor laws, and ensure that wages reflect productivity. While Malaysia's baseline growth is projected to remain steady, there are downside risks. A sharper than expected moderation in global demand or further escalation of trade tensions will have adverse spillovers to Malaysia's export and growth. For example, the current trade actions will weigh down Malaysia's GDP growth by 0.3 to 0.5 percentage points in 2019. This is already in our baseline growth projection. However, escalating trade disputes could have further adverse impact on domestic growth. These orderly adjustments in global financial markets and weaker than expected commodity prices also pose downside risks to Malaysia's growth prospects. Volatility will be a feature of emerging market financial market developments in 2019. Looking at last year, heightened global uncertainties triggered outflows from emerging market economies, including Malaysia, as we saw non-resident portfolio outflows of $8.9 billion. Despite the outflows, ringgit movements have thus been orderly, moving in line with regional currencies. The ringgit remains one of the better performers in the region and has appreciated in 2019. Nevertheless, as global uncertainties prevail, we should expect periods of volatility going forward. The flexibility of the ringgit exchange rate continues to be a key source of strength for the Malaysian economy. It acts as a shock absorber for the economy, increasing its resilience when faced with external shocks. What we want to avoid is excessive ringgit volatility, as this may have negative implications on the economy and financial system. In this regard, the bank continues to ensure orderly market conditions and manage excessive volatility so that the intermediation process is not disrupted. The bank also maintains a broad range of policy instruments, which includes targeted prudential policies and financial market measures to ensure that financial market activity is not disrupted. Price adjustment in the bond and equity markets have also been orderly. This is a reflection of the structure of the domestic financial markets. The diversified investor base, which includes domestic institutional investors and long-term non-resident investors, ensures a more resilient domestic financial market. The bank has also taken active steps to liberalize and enhance its foreign exchange administration rules. Recent efforts have been directed towards ensuring that market participants have better accessibility to onshore hedging facilities to manage foreign exchange risks. On this note, the bank is pleased to announce the following measures as part of our ongoing liberalization of foreign exchange administration policies. This is intended to enhance businesses' hedging flexibilities for better foreign exchange risk management. First, residents can now extend their hedging of foreign currency obligations from 6 months currently up to 12 months. Hence, businesses can now better manage their foreign currency exposure to provide greater certainty to their business planning. This measure is effective immediately. Second, SMEs with net import obligations will be able to receive payment in foreign currency from resident exporters for domestic trade in goods and services. We recognize that some SMEs have limited hedging capability. Therefore, this flexibility is important to allow SMEs who are net importers to have a natural hedge in global production chain, thus minimizing their FX risk. This measure is effective 2nd May 2019 to provide time for banks to set up this flexibility for eligible SMEs and the resident exporters. The bank will continue to review our FEA policies in a progressive manner to facilitate businesses' efficiency while at the same time ensuring financial stability. There are also concerns surrounding Malaysia's external debt repayment capacity and sustainability. It is important to recognize Malaysia's external debt is driven by unique factors that are a function of our openness, notably the high presence of foreign banks and multinational corporations, extensive regional network of our domestic banks, and the high degree of financial openness and highly developed domestic debt market. Two key factors suggest that the risk posed by external debt is fairly contained. First, close to one-third of external debt is denominated in ringgit and thus not subject to currency fluctuations. Second, the debt that is denominated in foreign currency is subjected to prudential and hedging requirements. What our researchers have done is to project external debt for the next 5 years and stress test the debt by subjecting it to various adverse shocks, such as a steep decline in current account balance, sharp slowdown in economic growth, severe exchange rate depreciation, or a significant rise in interest rate. Results show that under the baseline projection, external debt will decline to 56% of GDP by end 2023, facilitated by continued current account surplus and economic growth. Faced against the adverse shocks, the external debt will rise above the baseline projection but remain manageable due to natural mitigations attributed to Malaysia's debt profile and external buffers. So what is the role of monetary policy in this environment? The current monetary policy stance is accommodative. What this essentially means is that monetary policy is at a supportive level for economic activity to take place without compromising price stability. I cannot speak too much on future policy as we at NPC make our decisions collectively, but what I can share as the Governor and Chair is that this broad policy focus is likely to remain so this year. Policy rate considerations are also complex and multifaceted. We will have to keep a watchful eye on a broad range of indicators in order to assess how all the global and domestic developments that we described earlier interplay to affect our domestic growth and inflation prospects, conditions in our financial markets, as well as for signs of destabilizing financial imbalances. In other words, the decision on monetary policy will be data dependent. I must also stress that any adjustment in the OPR does not immediately suggest that there are risks to growth, as we are not a growth-targeting central bank. It is because when you triangulate all the considerations, there is a need to adjust policy. As I conclude, I hope questions that were raised earlier have found its answers. Barring any shocks, the Malaysian economy is expected to remain on a steady path, driven mainly by private sector spending, capacity expansions, and recovery in the commodity sector. There are downside risks to growth, arising mainly from external uncertainties. They will certainly warrant close monitoring. Nevertheless, a solid economic foundation will enable Malaysia to navigate these headwinds from a position of strength. Firstly, Malaysia's diversified economic structure will aid to mitigate concentration risks, supported by a resilient private sector. Secondly, having deep financial markets ensures that financial market adjustments to shock will remain orderly, while flexible exchange rate and adequate international reserves act as buffers against external shocks. And lastly, our government and Bank Negara have the capacity to deploy appropriate policies to manage macroeconomic and financial stability risks should the need arise. Let me briefly report on the bank's financial position. For the year 2018, the financial position of Bank Negara remains stable. As at 31st December 2018, total asset amounted to 447.64 billion ringgit. Out of a net profit of 7.52 billion, 5 billion was transferred to risk reserves and 2.5 billion was paid as dividend to the government, while the remaining 21 million was transferred to the General Reserve Fund. Now let me turn to the Financial Stability and Payment Systems Report, which provides our assessment of risk to financial stability, the capacity of the system in managing this risk, and policy responses and measures taken to bolster the resilience of the financial and payment systems. In 2018, domestic financial stability has continued to be supported by orderly financial markets and strong financial institutions. This has ensured effective financial intermediation and sustained public confidence in the financial system. Financial institutions continue to remain strong capital and liquidity buffers, which remain comfortably above minimum regulatory requirements. These buffers are further supported by adequate provisions for potential loan losses. Financial institutions also remain resilient against severe macroeconomic and financial shocks on the stress test conducted by the bank. At the end of the stress test horizon, the solvency positions of both the banking system and insurance and takaful industry remain above the regulatory minima. Banks' profit remained stable in 2018 with continued strong support from financing activity. This, coupled with continued efficiency gains, have notably led to an improvement in interest margins. Nonetheless, net margins from financing activity is expected to remain under pressure in an environment of strong competition, particularly in the retail lending market. While profits did grow at a slower pace last year compared to loan and asset growth, overall profitability of banks in Malaysia is not excessive and has been largely in line with rating and regional peers. In the household sector, household debt remains elevated, although growth in debt is now more in line with household income and assets. In 2018, household debt grew by 4.7%, while the ratio of household debt to GDP continued to decline to 83%. The share of debt accumulated by vulnerable borrowers has also declined further. Notwithstanding this, pockets of risk remain. Higher incidents of default have been observed among borrowers with loans for the purchase of higher-end properties and lower income earners with personal financing. While this does not currently pose direct risk to financial stability, it can increase risk to the broader economy and indirectly to the financial system if households become more vulnerable to financial shocks, and this impacts consumption. It is therefore important that measures continue to be taken to strengthen household resilience and improve their financial well-being. During the year, several measures were taken to ensure fair and transparent practices by banks in relation to housing loans and to require banks to help borrowers with persistent credit card debt to pay down their debt faster and avoid higher financing charges. The bank also continues to intensify efforts to improve household financial literacy, which remains low. As this is a shared responsibility, the bank is working with its partners in the financial education network to develop a national strategy for financial literacy, which will drive actions to elevate the financial capability of Malaysians. In the housing market, the supply and demand mismatch continued to persist. Unsold houses increased by 32% as at third quarter of 2018. Almost 3/4 of these units are priced above 300,000 ringgit, of which more than half are priced over 500,000 ringgit. However, we do expect imbalances in the housing market to gradually improve, supported by two key factors. First, more recent data shows the 2014 to 2016 compounded annual growth in house prices at 5.7%, which is more in line with income growth of 6.8%. And this is in stark contrast to trends in earlier periods where house prices were growing more than 2 times faster than household income. Second, we are seeing a gradual rebalancing of housing supply towards the more affordable segments. In 2018, a higher share of new housing launches were priced below 500,000 ringgit. Demand for affordable homes will be further supported by various initiatives recently introduced by the government and the bank. Meanwhile, oversupply of office and retail space is also expected to persist. With further large incoming supply of new shopping complexes in major cities, risks remain elevated that additional unabsorbed commercial space will continue to weigh on rental rates and property prices. Banks' exposure to the office space and shopping complex segment remains small, thus limiting risk to financial stability. However, appropriate strategies by authorities and developers will be critical to mitigate risk of a broader impact on the economy. Business debt increased slightly in 2018 to 103.7% of GDP, mainly from domestic financing. Despite multiple headwinds, overall businesses continued to be in a reasonably healthy position with debt servicing and liquidity position that remain above prudent thresholds. Risks from external borrowings are also well contained. The bank sensitivity analysis further reaffirmed financial institutions' resilience against potential losses from exposure to large borrower groups under severe stress scenarios. Collectively, the shocks that are applied in the stress test are more severe than what has been experienced in the past. Such losses would remain well within the current level of banks' excess capital buffers. Looking ahead, the bank remains vigilant over higher levels of domestic debt and imbalances in the property market. Risks to financial stability are largely mitigated, but broader spillovers could expose the financial system to future risks. Prudent and responsible risk-taking by financial institutions is therefore critical to prevent a build-up of vulnerabilities that could impair financial intermediation activities and harm the economy. The current outlook for financial stability remains broadly unchanged. Strong and resilient financial institutions will continue to be a key strength underpinning domestic financial stability, lending firm support to financial intermediation and sustainable economic growth. In 2019, the bank will continue to focus its regulatory and supervisory activities on strengthening the resilience of the financial sector to emerging risks. This will include the ongoing implementation of Basel III standards. Financial institutions are implementing these reforms from a position of strength, thus minimizing any short-term costs. Focus will also be given to strengthening financial system resilience to operational disruptions and cyber threats arising from the more pervasive use of technology in the provision of financial services. We will also continue to strengthen safeguards to prevent the abuse of the financial system for criminal purposes. On this note, Malaysia's efforts have recently been recognized by the Financial Action Task Force, or FATF in short, which upgraded the compliance ratings of our AML-CFT framework in 4 additional areas. The bank is also considering other potential measures to limit the abuse of cash by criminals. We are studying and will consult widely on the potential introduction of an economic-wide limit for cash transactions in Malaysia, similar to measures that have been taken in several countries. In addition, further measures to accelerate the migration to e-payments will continue to be pursued to reduce the use of cash. Finally, developments in financial technology can be harnessed to increase efficiency, support better risk management, and enable the provision of more inclusive financial services. As part of the bank's Open API initiatives, the bank last week launched the first phase of its Open API technology platform with the publication of 12 datasets on the platform. This would enable third-party developers to directly leverage publicly available statistics and datasets maintained by the bank in new and innovative ways to meet different needs and purposes. A similar initiative is being undertaken for data maintained by financial institutions under the industry's Open Data Implementation Group. As an initial step, the group has developed standardized specifications for open APIs, which will enable financial institutions to publish data related to SME financing, credit cards, and motor insurance or takaful products for access by third-party developers. In the e-payment space, the implementation of interoperable retail payment platform, or Do It Now, has enabled instant electronic payments to be made conveniently by referencing mobile numbers. We expect mobile payment solutions to gain significant traction going forward, which will further spur the migration to e-payments.